The Bank of Canada has announced today that they are holding the key interest rate steady. Is this the signal of the bottom of the market that everybody has been waiting for? Hi, my name is Adam Nadler. I'm the owner of Vision Real Estate. Thanks so much for tuning in yet again. We're going to be talking about the Bank of Canada's announcement today to hold the key interest rate steady. We're going to go over the numbers of exactly what's going on in the market so you can understand what to expect moving forward into 2023. And if you have any questions about the market or about anything that we talk about in this video, feel free to book a chat with me using the link in the description below. That'll connect you to a calendar where you can book a quick chat with me at a time that is most convenient for you. Or feel free to just shoot me an email to adam@visionrealestate.ca, any question you have, and I will get you an answer within 24 hours. All right, so let's get started. The Bank of Canada has made it very, very clear that they are resolute in bringing inflation down to the 2% target. And their message is that the data is reflecting that overall, that the latest data remains in line with the bank's expectation that CPI inflation will come down to around 3% in the middle of this year. Now, that is a pretty big claim considering the fact that we're almost double that number right now, hovering just under 6%. But so far, so good. The Bank of Canada has raised rates every single announcement that they've made in the last year. We've seen 8 increases in the overnight rate in the last 12 months. And while headlines have been predicting doom and gloom crash scenarios, everybody's still waiting for that doomsday or apocalyptic crash. It doesn't seem to be happening. And we see that reflected in the month-over-month price comparisons and other metrics. So let's jump into the metrics and take a look at the actual numbers of what we're seeing with the real estate market. But just before I do, if I could ask you very kindly to subscribe to the channel if you are enjoying this content, if you're getting value from it, hit that like button so this video can be pushed out to more people like yourself. Okay, so the first thing that I want to go over is sales volume. Of course, we are down compared to a year ago, which was the peak of the market, by about 47%, but month over month, we are up 8.5% in sales volume. And make no mistake, 8.5% in sales volume month over month as an increase is substantial given the current economy and the climate that we're in. I do believe that as we move forward into the spring months and the weather starts to warm up, we're going to see that number increase substantially, especially with this Bank of Canada announcement. Now let's move over to average price. And of course, it is way, way down when we're comparing it to a year ago, which was the peak of the market. So average price is down year over year by 17.9%. But once again, if you look at the month over month change, it's almost zero. We have been seeing the market flatline in terms of average price for the past 2 or 3 months. And of course, it's because we have really low inventory. Nobody's putting their house up for sale right now. Total new listings is down 40.9% year over year, and the sales to new listings ratio is down 7%. Now, one main takeaway that I think we should all be considering, given the fact that the interest rates have now stopped, at least for now, and we have really low inventory, is that as sales volume starts to increase, and we do not see the new listings coming up to match that, it is going to push pricing up. So to everybody out there, please expect a much busier spring market. At least that's what I think. I could be totally wrong. Let me know what you think in the comments below. But let's move on to some of the more shocking numbers that will get some good clicks. Property days on market is up 200% year over year, and listing days on market is up 144.4% year over year. Now, of course, this is just a blowout compared to last year where everything was selling super quickly. So there is no real surprise there, but the numbers sure do look shocking. And now let's jump over to see what the condo class is doing. And I really have been focusing on condos versus detached in my previous videos, and you'll see why here. It's because the condo class is doing extremely well as an asset class compared to the detached market in Toronto right now. Although the total sales is down 54.1% year over year, which is on par with everything else in the market, the average selling price hasn't moved at all year over year. It is a 0% change. As an average, if you had bought at the peak of the market last year, but you bought a condo, you shouldn't have seen any loss over one of the biggest corrections that the Toronto market has seen in decades. And again, it's because inventory is extremely low and a lot of people are not feeling so scared to be in a city anymore. Total new listings is down 14.3% year over year, and the sales to new listings ratio is down 41% year over year. And of course, days on market is up year over year, just along with everything else, but not as drastically. For condos, it's up 50% year over year. And of course, the rental market, I do want to touch on for just a second because it is still just booming. The average 1-bedroom apartment rental price has gone up 19% year over year. And of course, total apartment rentals are down 19.9% year over year. And it's because, well, total new listings down 11.8% year over year. So yes, the higher interest rates have definitely hurt some people, but overall, Canadian mortgage delinquencies are near record lows. Canadian mortgage costs might be on the rise, but payments are showing no signs of stress. In fact, annual growth for the share of delinquencies showed a significant decline, about 10%, and just 0.18% of outstanding mortgages were 60 days past due, the lowest in this decade and likely a record. So people are paying their mortgages. People are tightening the belt, they're cutting out unnecessary expenses, and they are bearing down for the higher interest rates. And we still have record immigration happening in Canada moving forward for the next 2 years. On average, we will be taking in approximately 500,000 people. And of those people, about 60% of them are coming in on economic programs, meaning they have money to purchase real estate when they get here. We know that on average, about half of those people end up in Toronto or the GTA. And in Toronto, we only build about 35 to 38,000 units per year. So when you look at the numbers, I've said it before and I'll say it again, we have a massive housing shortage. Our market is looking rather healthy compared to the rest of the global markets, and people still have their jobs. Unemployment is not rising anywhere near as quickly as people thought it would. So it is, in my humble opinion, that we are going to see a busier spring market for real estate in Toronto. But hey, that's just what I think. Let me know what you think in the comments below. Do you think that the market has bottomed out, or is the market's bottom about to fall out from underneath us? Thanks for tuning in again, and I'll see you next time. If you like that video, click the subscribe button on the right, or feel free to enjoy another video here on the left.